Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with our sponsors, Admiral Markets. It gives me great pleasure to reintroduce Mr. Darren Sinden, market commentator for Admiral Markets. And Darren, how are you?
Yeah, very well, thank you, Nick.
How's your week been?
Very interesting, really. I mean, August has often been,
a dull month.
Yeah, yes, indeed. It's been anything but so far. So we may yet quieten down towards the end of the month.
Well, it was extraordinary on Monday. I was sort of on one of the other shows that we do. I was saying that we were data light this week, and we weren't expecting any fireworks, and it was far from it with the Chinese devaluation.
Yeah, and nobody really saw that coming. Maybe
anytime soon.
No. I mean, it was possibly on the cards at some stage, but it certainly wasn't factored in for this week or any time this quarter really. So no, that's certainly given people pause for thought and shaking the markets up, and as we'll see a little bit later, done some serious damage in various
markets. Okay, well, we've got a number of slides if you're watching for the first time. Let's kick off with the first one, data released over the European session.
So all the focus really today on Europe and for Q2 GDP figures. So we'll start right at the top with Germany, obviously biggest economy in Europe and therefore the one that most people have got an eye on. Q2 GDP came in at plus 0.4%, so that is growth, but it is below, some 20% below the forecasted level of 0.5% and only fractionally above the prior read of plus 0.3%. And as we move down the list, in France, same data, Q2 GDP, nothing, flatline, 0%.
So a miss.
Against a forecast of 0.2 and the prior read of 0.7, so a real disappointment there. Italy, again disappointing, perhaps not by as much, but plus 0.2% against a forecast of 0.3% for their GDP read. And then the cumulative read for all of the Eurozone, plus 0.3%, again lower, 25% lower in this instance than the forecast of 0.4% and the prior read of 0.4%. And the last number, Eurozone CPI for July, down 0.6%. Strangely enough, that's bang in line with the forecast of minus 0.6%. But again, both those numbers below the prior read of 0%. So if you're the ECB, you've had 5 going on 6 months of
printing money.
Yeah, you've stuck in some almost 300 billion rather, euros.
It's deflation, not inflation.
Yeah, and you haven't really achieved anything by the look of it. You're certainly not stimulating the internal market. You're not managing to drive prices higher, or at least it's that if you are, it's not showing itself in the data yet. So I wonder if they're scratching their heads and wondering what they need to do going forward.
Understood. Okay, so let's move on to the Euro movers.
Okay, well, the equity markets and individual equities pretty flat today, no real standout. So I thought we'd take a look back over how some of the leading European equity indices have performed this week. The table here, demonstrates that quite clearly. The 1 week performance numbers in that last but one column in red. As we can see, right at the top, the DAX there down 4.9% on the week. The AX in the Netherlands down 4.8%. Euro Stoxx 50 down 4.2%, the Euro Stoxx down 3.8%, and the IBEX down 2%. Of course, the DAX still up 12% on the year, as is the AX, and the Euro Stoxx and the CAC still doing very well year-to-date basis. But I do note that in Spain, we know 2.7%. negative is quite a big chunk off of the year-to-date performance. So the markets have taken a big whack. They're down but not out, shall we say? And I think today's quite a session. They're paused for breath and waiting to see what happens next. Just a couple of things to flag that are of interest to people, or should be of interest to people. First of all, there's still a big gap in the DAX chart to fill between 11,153 and 11,278. So that's a set of levels to keep an eye on. And also I note that the Euro Stoxx is sort of Euro Stoxx rather 50 is stuck between midway, in fact between the 50 and 200 day EMA lines. So again, I'll be watching those very closely because it's got to find a direction in one way or the other and break up or down above those lines.
Understood. Okay, so let's move on to M&A, rumours and movers.
Another done deal from the US announced late last night. Goldman Sachs, as ticker GS, is to buy GE's, ticker GE, online US deposits business. No financial terms were disclosed. Sources have suggested that the money that changed hands wasn't particularly material to either party. But it does mark the end of one era and the beginning of another. GE's been winding down its financial business recently, so its healthcare finance arm to Capital One, and this is all part of the wind down of GE Capital. That was a finance division that once made 50% of the conglomerate's profits, but almost brought it down completely in 2008 in the global financial crisis. So they're shutting it down. This is the last sale, and the rest of the assets now, I believe, are just going to be wound down. Why is this an interesting deal for Goldman Sachs? Well, it gives them access to $16 billion of deposits. Not a huge number, but they've been encouraged by the federal authorities to diversify their funding sources, and deposits are seen as a stable source of funding as opposed to market-driven funding sources, which, as we recall, or people with any kind of long memory will recall, was the problem that banks in the UK, like Northern Rock, found themselves facing in the crash. Because no one was prepared to lend to them in the market. So if you've got customers with deposits, those deposits tend to stick with you, and that's a more ready and reliable source of funding. It's not the first thing that Goldman looked at in terms of buying a sort of public-facing bank. They did look at ING Direct a few years ago, but missed out, funnily enough, to Capital One. As I say, the Fed has basically pushed them in this direction to diversify their funding base. Well, they're also, interestingly, about to launch their own consumer loan business as well, which may or may not be a good thing, but we'll come on to that perhaps another time.
Okay, so let's move on to US data points to keep an eye on today.
Okay, well, as you said, it's not the fullest calendar as far as data this week, but we have got PPI, the final demand figures, so the final read for July. This is a month-on-month figure. Again, we're not looking at anything too exciting. The forecast is for modest growth in prices of plus 0.1%. That compares to the prior read of plus 0.4%. So any deviation in either direction from that forecast could give us a clue about the future trends in inflation in the US. And then probably the more important number or numbers today, industrial production for July, again a month-on-month number, forecast to rise by 0.4% against the prior read of 0.3%. And within the industrial production figures, capacity utilisation, this is the amount of manufacturing capacity and industrial capacity that the US economy is actually using at any one time. 78.1% is the expected read. That's exactly in line with the prior read of 78.1. If we were looking for the US economy to give a sign of continuing growth, you'd obviously want to see a higher number there rather than a lower one, but we shall see.
Okay, let's wrap up with the US pre-market movers and levels.
Okay, well, the first of our pre-market movers will probably be very well known to many of our viewers, King Digital Entertainment, that's ticker KING in the US, $13.45, down 11.5%. Profits have fallen 28% here as the Candy Crush game makers' revenues continue to decline. And hard that might be to believe, Candy Crush is actually 3 years old now. And of course, games are notoriously,
I actually downloaded that for the first time this week just to see what the fascination was.
Well, yeah, it's obviously held lots of people's attention, but 3 years is a long time to do that. And I guess consumer interest is waning, hence the decline in profits. It's up to King Digital now to try and enhance the game or come up with another winner.
Yep.
And then, for a change, we're not looking at a stock in our second pre-market mover, but rather a commodity, and this is WTI light sweet crude, the American oil contract, trading around $41.99. That's down 5.4% week to date. We're quite bearish still of oil prices, and just to flag some levels that will be of importance. This obviously priced in the electronic session before the proper session opens a bit later. So look for in proper trade, look at the 15th of March low at 42.06 and see how we trade around that. A close below today would be bearish. If we do close below there and close below significantly, there's not much in the way in terms of support between that level and the 09 low of 33.55. May not go there in one line, but the trend is obviously downward.
Trend is your friend, as they say.
Doesn't seem to be much to disrupt that at the moment. And then in terms of levels to watch today, not too many changes from yesterday as far as the equities are concerned. 65.40 is our downside level now to watch on the FTSE, plays 66.35 on the upside. In the DAX, 10,957 on the downside, but that gap level that we highlighted earlier in the programme of 11,153 is now the upside level to watch. For the S&P, slightly adjusting the ranges here. 2076 on the downside, plays 2094 on the upside. And for the Dow, 17,340 to the downside, plays 17,480 to the upside. We've seen some very indecisive candles there, though, in the last couple of days, and I think that's just indicative that the market doesn't really know what's coming next. Currency-wise, euro dollar, the euro still pretty firm, 111.23 now, our downside level to watch against the dollar, plays 111.76. Perhaps the surprise of the week has been how resilient the Aussie's been, probably, as I say, more to do with the weaker dollar than a rally per se in the Aussie, and maybe a bit of short covering there as well. 73.58 is the downside level to watch there, and I've gone with 74.00 on the upside for a bit of round number value.
Resistance, yep.
Dollar yen, a similar story here, 124.00 on the downside. 123.70 has been flagged in my office as well as a key support. So if that 124.00 gives way, look for that. But if that lower level holds, and I'm told we should expect a big bounce, and we go with 124.62 on the upside with 125.00 the next level beyond there. And then cable, no great shakes here, no real change, just slight easing on the downside. So 155.86 now our downside level to watch, plays 156.36 to the upside. Again, really searching for directional cues there.
Understood. Okay, Darren Sinden, market commentator, Admiral Markets. Thank you for that. That wraps up the Wall Street crossover show. We'll be back same time, same place, 1 o'clock. As we always say, have a good weekend. Thank you.